I'd like to welcome everyone to Advanced Markets webinar series, How Does Depth of Market and Block Trading Affect Your Transactional Cost? I'd like to start off with a brief background on advanced markets before we just hop into everything. Advanced Markets is a true STP, Prime or Prime, regulated by ASIC as a wholesale brokerage. We're owned by Macquarie Bank and GFI, a division of BGC Partners. We're primed by UBS for all margin accounts. Now that we have a little bit of background on who Advanced Markets is, let's touch upon some of the features that interest our clients and sets us apart from other industry types. We deal in FX, metals, energies, commodities, CFDs, and provide up to 100-to-1 leverage. We have multiple liquidity channels via MT4, Fortex proprietary desktop, web platforms, Fortex Web MT4. Our matching engine is in Equinix NY4 data center. We own private cages in NY4 HK3. We're cross-connected to major banks, ECNs, and we also have enhanced safety of funds through segregated custodial accounts at Macquarie Bank, otherwise known as the tri-party account. Because of all these factors, our institutional client base at Advanced Markets, Liquidity serves over and estimated around 40,000 institutional and individual clients in more than 30 countries. Some, but not limited to, the banking partners we utilize for liquidity. As you can see, Bank of America, Barclays, BNP, JP Morgan, Morgan Stanley, Nomura, Macquarie, UBS, Deutsche Bank, and there's a few others here that don't want their logo, but it's, Citibank, Goldman, all the household names of major banks. To use all these banks in our aggregated price feed, we use a top-tiered prime broker relationship with UBS. They're kind of a good standard to have a prime broker with. Now that we had a little background on the company and what we do, a little on the presenter, myself. As you know, my name is Richard Perona. My main concentration was in the institutional side as a spot dealer. I ran a retail brokerage as the chief dealer. I have ran a CTA in the USA, along with being a co-founder of an IB shop. So let's just take a look at the topics we'll be covering in this presentation today. What is depth of market? Subset of how to read depth of market. Order types, why they matter. Understanding the VWAP. Execution. Second part is what is block trading or fox trading? The background on block trading or fox trading, how it works. Who will benefit from the block trading or the fox trading? And at the end, I will put a side-by-side comparison of a case study between how VWAP will be executed and how fox will be executed, and why it will benefit and who will benefit, and the types of people that would really benefit from this. So let's jump right in. What is depth of market? Depth of market provides an indication of liquidity available for that particular instrument. It provides an electronic list of a buy and sell orders organized by price level and updated to reflect real-time market activity. Let's touch upon what the depth of market looks like in the aspects a FX brokerage should be able to display in their aggregated price feed or pool of liquidity providers. As touched upon in previous slides, Advanced Market setup uses UBS as a prime broker and connects to all major banks to create our liquidity pool. Let's take a look at how to read the depth of market and some of the important features that this indicator provides. The first thing I look at is what symbol we'll see, and we got gold up here. The second, of course, you always want to look at is the spread. It's just right at the top. Last price, so you know which last given price was executed at. the bid and the ask, two quick ones right up here that actually create the spread. Then you start to look into the size and quantities of what is given on the bid and the offer. You get all these down here to see what exactly is being provided at what rate. Another one is the VWAP. We'll touch more on that. That is the volume weighted average price of how many of these transactions, and you can actually get the price at the end. We'll again dive a little deeper into it. And it may make sense, it may not make sense. You can see which banks are providing the different orders as we go. You got Deutsche Bank, UBS, JP Morgan, Goldman, and all the way down the list. So we can get into that as well. Some of the features, but they're not limited to, is what I look at when I'm reading the depth of market. Now let's use this information and dive a little deeper into the different order types a brokerage can offer, along with how they differ in the execution functionality. The two order types Fixed API will accept is the limit and market orders. Limit orders is given to a brokerage to buy or sell at a specific price or better. The second order is market order. Market order is given to the brokerage to buy or sell to be executed immediately at the current market price. Market orders are used when certainty of execution is a priority over the price of execution. After touching upon the two orders, let's go a little further and touch upon the time and force parameters to see how they differ in the execution. The first time and force parameter is GTC, the most common one, or good till canceled. This order will continue to work until the order is filled or canceled at a specific price or better. The second order, time and force parameter, is FOK, or fill or kill. This order dictates that the entire order must be executed immediately or canceled. The third time and force parameter is IOC, immediate or cancel. This order requires all or part of the order to be executed immediately and any unfilled parts of the order to be canceled. Partial fills are acceptable. Now let's use this information and dive a little deeper into market order execution with the VWAP. As mentioned in the previous slide, VWAP is an acronym for Volume Weighted Average Price. It shows a list of available trade sizes and the expected price at which the trade can be executed. For example, if a trader would like to sell 10,000 ounces of gold, it would take 12 legs to execute. Of course, we know the sell is going to be on the left-hand side. We look down to here. There's 10,000 ounces of gold. The price would be $12.2978, meaning all these legs down here are going to be executed until you reach your 10,000 ounces of selling. Now, the price of $12.2978 is indicative of where the order could be filled. As the market is constantly moving and the order is being processed, not every order we see in the depth of market window could be filled. Each transaction takes time to complete. The market is still moving and refreshing prices constantly, which could result in different pricing from where the trade was first initiated. Of course, everyone knows this is called slippage. Now that we touched upon market orders using VWAP, let's look at what a typical market order with multiple transaction or legs would look like. Let's take a minute and look at this slide. A market order to buy 5 million Aussie Sing, or Singapore dollar, was sent to our aggregator when the offer rate was 1.03823. right here. Example to buy. You have an order entry to buy 5 million Aussie Sing at the market. The first price, or top of the book price, is 1.0382.3. Once the first fill, or the top of the book, was done at 1.0382.3, that leg was filled. The system will continue on to the next best offer price available until the full order of 5 million is done. As you see, as soon as this is done, the next best price was 81.6, 1.9 at 82.6, then half a million at 82 figure, and then 81.7. I broke it down to see exactly how the VWAP and the calculation will work. You do it by price, the Singapore dollar, and divide it by 5 million Aussie to arrive at a final price of 1.0382.1. So the initial price was to buy at 0.3823, and you actually had some slippage of 0.2 in your favor to buy the 5 at 82.1. So as the market was moving, we can see that not everything stayed exactly where it should be, and the price was in your favor. Now that we looked at the depth of market, the type of orders, right, so drawings, the type of orders, their time and force parameters, the execution, I'll now walk us through what block trading or fox trading is. Block trading is an order or trade submitted for the sale or purchase of a larger quantity. At Advanced Markets, we call it FOX, or full order execution. This enables a trader to execute larger trades anonymously on our aggregated multi-bank liquidity feed in a single fill transaction with a single bank. Why is this important? Let's look at a little background and the benefits of block or fox trading. Block trading is generally used in equities or bond facilities, but it does apply to FX when dealing with an aggregated price feed. When executing a larger order, dealing with a single LP outside of the general venue of the aggregated price stream, the trade will not cause adverse price movements on the market price, as other banks will be unaware a larger order has even hit the market. These type of larger block orders are done by the institutional types, Wall Street, such as hedge funds, buy-side firms, larger institutional clients, fund managers. Now that we've covered the benefits of block trading, let's visualize what a block or fox trade in execution would look like. The Fox liquidity feature features one fill, one ticket, full amount filled. As mentioned, the benefits would be no market impact while obtaining the best bid or best offer for the amount requested. Now, this is just a mock-up of what it could look like, but if we run a Fox feed of 20 million and ask all these banks to provide their best 20 million feed, it could look just like a depth of market, with the highest one being Deutsche Bank on the bid and JP Morgan on the offer for 20 million. The best bid, best offer, we put at the top, and as soon as you request it, the 20 million, Deutsche Bank to sell, and JP Morgan to buy, and it all goes down into our aggregator, and we take care of the credit with our UBS and our PB. Now let's look a little further at a snapshot of what Advanced Markets Fox feed looks like. In this snapshot of Advanced Markets Fox feed, we see it similar to the depth of market without the VWAP, as Fox orders will be filled on the sides closest to the order requested. For example, if a trader decided to sell 20 million euro dollars, the Fox feed would match him and fill him in a single transaction all the way down at 1.12.2002 directly with BNP. As we said before, we look at the bid and offer and the spread is 0.2. And we can see the top of the book, if you want to sell, is 2009. And if you want to do a full 20 million order, you're going to get filled at 02. If you want to execute on VWAP, you could see you'd have to chew through all these to get down here, or have an aggregated price feed to get through to obtain the 20 million. Again, this limits the market impact while obtaining the best bid and best offer for the 20 million. Now that we saw this, let's see how the depth of market and the Fox feed match up. Or who will benefit from it as on this. So you get the VWAP and you have the Fox feed. On this slide we see both the VWAP and the Fox feed taken about at the same time. It's very similar. It's very hard to do, but we took a snapshot milliseconds apart. As you know, the market can move, so let's just walk right through this. As we know, it's both euro dollar. You get the spread for both of them is 0.2, 0.2. The bid's off by a little, and the offer's off by a little, but that should be okay. The VWAP has many layers that are ready to chew through any executed order and as many transactions as it takes to get the completion of the fill. The price executed may vary, which, as we know, is called slippage, either positive or negative. If you had to do a certain price, it's going to have to use all of these down here. Now in the Fox, you can receive an exact fill when you request the trade corresponding with the amount you need. At Advanced Markets, we operate a true STP processing under ASIC guidelines as a wholesale primer prime. That gives us a unique capacity to ask our clients which price feed they would like to be executed on, or maybe even both. I did do a brief case study on this presentation. Based on our experience, this case study, we have found that understanding the type of trading a client will be participating in, we can determine the best feed for the client. Now let's walk through it. I've taken a snapshot from the previous slide of the euro dollar, and as we can see, in a single snapshot with moving markets, we found that a client executing between 10 or 15 million really benefit from Advanced Markets Fox feed, as it would reduce their slippage and reduce their market disruption. And the under 10 million can easily be done with a VWAP price feed. So let's just take a look. The VWAP to sell 10 on the previous slide would have to chew through 10 transactions to sweep this. You are at the mercy of the market or any market movements, but at the same time it's probably small enough to get done, and you'll be done around 06, maybe better, maybe worse. In the Fox, the market order to sell 10 million, you're just going to get lined up with Goldman Sachs at 12/20/07 directly here to sell 10. You might want to break it down to do 5 and 5 to try to get a little better price fill. Or you might want to use the VWAP or a limit price, depending upon how you want to trade. We can always determine this at our brokerage. Now that I kind of touched upon everything here, I'd like to thank everyone for your time and your attendance.